Welcome to today's deep dive. We are thrilled you could join us because today we are looking at a stack of sources that, at first glance, well, they might seem like they belong in completely different universes.
Yeah, it is quite the stack. I mean, we have a heavy-hitting geopolitical macro analysis from Alliance, a pretty dramatic market breakdown of the Asian markets from the
A
Cryptonomist,
smartphone industry report from MBSB Research, a premium gadget reveal straight from Ubergizmo.
an equity update on Tesla from Guru Focus, and to round it all out, a retail earnings summary for Target from MarketBeat.
Right, and taking these isolated reports and laying them out side by side, it reveals patterns that you just don't see when you read them one by one.
Exactly. The sheer breadth of information here spans virtually the entire spectrum of human economic activity right now.
And that is exactly our mission for you today. We are going to connect the dots. We are taking global macro shocks, technological bottlenecks, and everyday consumer retail, and we are going to prove how intimately connected the 2026 economy really is.
Okay, let's unpack this, starting with the biggest domino to fall recently, the geopolitical shock in the Middle East.
Right? The Alliance report. It outlines a massive geopolitical catalyst. We are talking about the recent U.S.-Israeli strikes on key military and civilian infrastructure targets in Iran.
And according to the analysis, these strikes resulted in the deaths of Supreme Leader Ayatollah Ali Khamenei, as well as multiple senior intelligence officials and leaders within the IRGC.
The Islamic Revolutionary Guard Corps, yeah, which
Yeah.
is essentially Iran's elite military and political force. Crucially, the U.S. has declared major combat operations.
Now, before we dive into the timeline and the strategic calculations outlined in this Alliance report, we need to pause and make something explicitly clear to you, the listener. The source material discusses the Trump administration's political calculations regarding this conflict. Right. And we want to state with absolute political neutrality that we are simply reporting the facts and the geopolitical analysis provided in this source material. We are not taking any sides here.
Absolutely not. Not left-wing, not right-wing. We are not endorsing the viewpoints of the content. Our goal is strictly to convey the ideas contained in the original document you shared with us.
Exactly. So getting back to the report, it details that the Trump administration has an incentive to seek a roughly 4-week resolution to this conflict. The strategy, as outlined by Alliance, aims for a transition to what they term a pragmatic ruler in Iran.
And a major driving factor highlighted here is the upcoming November midterm elections.
Yeah, the administration's calculation is to avoid a scenario where prolonged conflict leads to skyrocketing global oil prices, which would inevitably worsen the affordability crisis for American voters right before they head to the polls.
The transmission choke point for those global oil prices is really the crux of the issue here. A conflict in this specific region immediately threatens the global economy because it all bottlenecks at one narrow stretch of water, the Strait of Hormuz.
The scale of what moves through there is just staggering. The report highlights that 30% of global seaborne hydrocarbons,
Meaning crude oil and liquefied natural gas, or LNG.
right, 30% of it transits through this specific choke point. And the early indicators on the ground are alarming. Crossings through the strait are currently down by more than 70%.
Wow.
There are over 200 oil and LNG vessels just sitting there, completely stalled, anchored outside the strait.
200 massive tankers just parked in the ocean. The source notes this isn't necessarily because the oil facilities themselves are destroyed.
No, it's because of war risk insurance issues and precautionary operational pausing. Iranian Revolutionary Guards have been warning commercial vessels against transiting.
So even if the enforcement of those threats is uneven, the maritime disruption is immense. The immediate market reaction is driven by the inability to safely move the energy across the ocean, not necessarily a lack of energy coming out of the ground.
Which causes an immediate repricing of risk globally. Energy-dependent economies look at 200 anchored ships and realize their supply lines are effectively frozen.
Here's where it gets really interesting, because you might assume the immediate casualty of this would be Western energy markets, but the most dramatic financial wipeout actually happened in South Korea.
Yes.
Looking at our source from the Cryptonomist, South Korea's benchmark KOSPI index just suffered its largest one-day drop in history.
The market mechanics behind that drop are fascinating. The KOSPI plunged 12% in a single session.
12%.
That single move wiped out $625 billion in market value. The free fall was so violent that it hit the 8% circuit breaker, which completely halted all trading for 20 minutes.
But the panic was so deeply embedded that the moment the exchange flipped the switch and trading resumed, the selling just accelerated. Heavy hitters, the bedrock companies of the Korean economy, were totally decimated. Samsung Electronics plummeted 11.7%.
And the major memory chip maker SK Hynix dropped 9.6%.
Looking closely at the cryptonomist analysis, it becomes clear this wasn't just a simple reaction to expensive oil. Yes, South Korea relies heavily on imported fuel, but a 12% market collapse suggests something structural broke. This looks like a classic leverage trap.
It was a perfectly primed powder keg of debt. South Korean retail investors had been aggressively positioning themselves in the market, pushing outstanding margin debt to a massive 32.67 trillion won.
That is roughly 22.4 billion US dollars of borrowed money, propping up everyday retail portfolios.
Compounding this fragility, foreign investors had been steadily pulling out, selling a record 21.14 trillion won worth of equities in February alone. You end up with a market structure heavily reliant on highly leveraged everyday traders holding the bag.
So the Middle East energy shock hits, and prices start to slide on the initial geopolitical fear. Brokerages see the underlying value of these retail accounts dropping and start issuing margin calls.
They demand these everyday investors deposit more cash immediately to cover their borrowed positions.
Right, and when those investors can't find the cash or simply refuse to throw good money after bad, the brokerages step in and forcibly liquidate their stock at market price.
Which dumps massive volume onto the market, driving the prices down even further. That subsequent drop triggers a whole new wave of margin calls for the next tier of investors. It creates a vicious, uncontrollable feedback loop of forced liquidations. The circuit breaker didn't stop the panic, it just gave the brokerages 20 minutes to tally up how much more they needed to forcibly sell.
So, bringing this back to you, the listener, how does a macro shock of this magnitude ripple into everyday portfolios and global monetary policy going forward?
Well, Allianz lays out two highly specific scenarios. Their baseline scenario assumes the administration's strategy works and the conflict is resolved in under 4 weeks. Under those conditions, Brent crude oil peaks around $85 a barrel.
And the downstream impact on inflation in the U.S. and Europe?
It remains a negligible 0.1 to 0.2 percentage points. The Federal Reserve keeps its benchmark interest rate steady at 3.5%, and the broader market largely shrugs the event off as a temporary spike in volatility.
But the tail risk scenario paints a much darker picture if that 4-week timeline blows out.
Exactly. A prolonged war changes the math entirely. In the tail risk scenario, oil could surge past $130 a barrel before finding any equilibrium.
Wow.
The Fed would likely be forced to hike rates back up to 4.0% just to combat the resulting inflation spike from those energy costs. Under that sustained pressure, Alliance projects we could see a 20% drop in broad U.S. equities as economic growth stalls out.
There is also a complex liquidity risk tucked away in the Alliance report regarding the Federal Reserve. It involves the USD basis spread, which essentially measures the premium people are willing to pay to swap euros into U.S. dollars.
Right. When global panic hits, everyone rushes to hold dollars to buy oil or service international debt, and the cost of that currency swap explodes.
This raises an important question about international monetary stabilization. During the 2020 crisis, when we saw similar dollar funding squeezes, the Federal Reserve aggressively opened up swap lines. They essentially flooded the zone with dollar liquidity to calm the European banks and stabilize the markets.
However, Alliance explicitly notes that under the new Fed chair, Kevin Warsh, the Federal Reserve might be far more orthodox. They might be reluctant to extend their balance sheet to act as a backstop for global markets. If Warsh refuses to provide that liquidity, a localized energy shock could mutate into a global banking squeeze.
While that energy and liquidity bottleneck is choking physical supply chains, there is another, completely different type of bottleneck currently rewriting the global economy in the technology sector. Our source from MBSB Research paints a remarkably difficult picture for the smartphone industry, projecting it to contract by anywhere from minus 9% to minus 2.1% in 2026.
The culprit isn't a sudden lack of consumer interest in upgrading their phones. It is a severe supply constraint on foundational components, specifically memory chips.
The report essentially frames artificial intelligence as the favorite child of the tech world. AI development is absorbing all the capital, all the attention, and virtually all the manufacturing resources, leaving traditional consumer electronics fighting for scraps.
What's fascinating here is the sheer scale of the shift by major memory producers. We aren't just talking about shifting a few assembly lines. Micron Technology is completely stopping the sale of consumer memory by February 2026.
Entirely.
They're exiting that side of the business just to focus on feeding the insatiable demand for high-powered AI chips. Meanwhile, SK Hynix,
The exact same company taking a beating in the Korean stock market crash we just discussed.
Yes, them. They already have their entire 2026 manufacturing capacity completely sold out. Their production of memory is entirely spoken for by AI-driven enterprise contracts.
So if you are a mid-tier smartphone manufacturer, you literally cannot buy the silicon you need to build your devices. Looking at the MBSB research, it's clear who wins and who loses in this environment. The low-end smartphone market suffers the most.
Because they operate on razor-thin margins and rely on a high-volume, low-price strategy, with basic memory components becoming scarce and incredibly expensive, that business model simply breaks.
The survivors are the massive incumbents. Apple weathers the storm through unparalleled supply chain dominance and high-margin pricing power. Samsung survives because they are vertically integrated. They manufacture their own memory internally and don't have to bid in the open market against AI server farms.
Companies caught in the middle are resorting to desperate remedial actions. The research notes they are actively downgrading the memory specs in their upcoming phones. To mask this hardware downgrade from the consumer, they are being forced to invest heavily in software optimization just to make the operating systems run smoothly on a fraction of the memory they used to utilize.
While the low-end and middle markets are struggling to find cheap memory, the ultra-premium market is navigating this hardware constraint by moving in a completely different direction. Let's look at the Uber Gizmo coverage of the Mobile World Congress 2026. They unveiled the Leica Lights Phone 4, powered by Xiaomi, and it represents a massive pivot toward luxury tactile hardware.
It is the perfect strategic contrast. Leica's motto for this device is focus on the essential, and they are leaning heavily into bridging the gap between mobile technology and traditional mechanical photography.
The specs alone are wild. It carries a retail price of €1,999, which converts to roughly $2,318.
That is a serious investment.
For that price, you get a beautiful aluminum alloy body with a nickel anodized finish. The main camera features a massive 50-megapixel 1-inch sensor using LOFIC technology. That LOFIC tech basically acts as a capacitor buffer to prevent the camera sensor from getting completely blown out by bright lights, delivering massive, professional-grade dynamic range. And it pairs that with a 200-megapixel telephoto lens featuring true mechanical optical zoom.
But the internal specs aren't the real story. It's the physical interface. They added a physical Leica camera ring on the back of the device that actually replicates the tactile feel of a traditional camera lens, letting the user manually adjust zoom and exposure by physically twisting it.
Oh, that's clever.
Furthermore, they are pushing a Photography Kit Pro attachment. You snap this onto the phone, and it provides a non-slip PU leather grip, an extra 2,000 milliamp hour battery, and a professional two-stage physical shutter button, half press to focus, full press to shoot.
Differentiating through a physical mechanical experience rather than just digital processing power.
If we connect this to the bigger picture, it makes perfect strategic sense for 2026. When the entire smartphone industry is constrained by internal memory availability due to the AI boom, how do you stand out? You can't just throw more RAM at the problem or brag about processing speed anymore.
Right.
So Leica and Xiaomi are competing on ultra-premium tactile hardware experiences. They are making the phone feel like a heavy, luxury mechanical object rather than just a flat piece of glass in your pocket.
That pivot from digital specs to physical experience is a great segue into looking at some massive corporate maneuvers playing out in the equity markets. Let's start with a company that has entirely rewritten its own narrative. Tesla. Our source from Guru Focus highlights that Bank of America has resumed coverage of Tesla with a buy rating and a highly optimistic $460 price target.
The justification for that $460 target requires a complete mental shift in how the market values the company's core operations.
So what does this all mean? Looking at this BOFA report, it's fascinating to see it spelled out so starkly on a balance sheet. We all know Elon Musk talks up AI and robotics, but seeing traditional Wall Street analysts formally reduce Tesla's core car manufacturing business to a minority slice of its valuation really cements that this is no longer an auto company.
Bank of America estimates that robotaxis now make up a staggering 52% of Tesla's overall valuation. Full self-driving, or their FSD software suite, counts for another 19%.
And their energy division.
The energy division, which manufactures the Powerwalls and Megapacks for utility-scale grid storage, is valued at $90 billion, making up 6%. And the Optimus humanoid robot business is already being valued at over $30 billion, representing 2% of the company.
Meaning the actual traditional automotive segment, bending metal and selling cars to human drivers, is only 21% of Tesla's total valuation.
It is a total transformation into an Auto 2.0 mobility and artificial intelligence company. The report highlights that their primary strategic advantage in this space is their rigid adherence to a camera-only approach.
As opposed to LiDAR.
Exactly. While competitors are outfitting autonomous vehicles with incredibly expensive multi-sensor arrays, Tesla relies on cost-effective, standard cameras. They feed the visual data from millions of consumer vehicles back into their neural nets to train the AI. This massive data moat gives them a significant profit margin advantage as they prepare to expand their robotaxi operations into 7 new global markets.
From the cutting edge of autonomous AI and robotics, let's bring it right back down to everyday life for you. Let's look at Target's Q4 earnings call, courtesy of MarketBeat. While Tesla is betting the farm on autonomous software, Target is placing a massive, multi-billion-dollar bet on the physical brick-and-mortar retail experience.
Target's CEO used this earnings call to announce a new chapter for the company. They're intensely focusing their entire strategy around a core demographic they refer to as digitally fluent, busy families.
And the guiding principle for this new chapter is a single word: delight.
They have recognized that in 2026, physical retail has to be an engaging destination. If the store isn't delightful, that busy family will simply buy what they need online.
They are backing up that philosophy with a total merchandising overhaul. During the call, the chief merchant essentially admitted they had lost their way a bit, particularly in their home goods departments, which used to be their strong suit.
To fix this, they are forcing the supply chain to move incredibly fast. They are shrinking the time to market for apparel from over a year down to just a matter of weeks so they can actually stay on trend.
By June, they plan to have fully refreshed over 75% of their home decorative accessories. They are also rolling out highly immersive Target Beauty Studios inside 600 stores.
Rebuilding a supply chain to operate in weeks rather than years and redesigning hundreds of stores to create delight is an incredibly expensive proposition. Target's CFO outlined a financial plan requiring more than $2 billion of incremental investment in 2026 alone just to execute this turnaround.
Breaking down those financials from the MarketBeat summary, about $1 billion of that is going directly into the profit and loss statement. That means immediate spending on store labor, team training, the logistics of major merchandising transitions, and marketing.
On top of that P&L hit, they're committing to $5 billion in total capital expenditure for the year. That CapEx is what will actually fund the real estate, opening more than 30 new, massive full-size stores and completely remodeling over 130 existing locations.
The obvious question is how a retailer funds a multi-billion-dollar pivot without destroying its balance sheet. Target is essentially funding this by lapping a lot of bad news from the previous year. In 2025, they were hit with about $500 million in one-time tariff and inventory penalty costs.
Because those penalties won't repeat this year, they are taking those massive savings, combining them with a couple $100 million saved from recent corporate headcount reductions, and immediately reinvesting all of it directly into the stores.
They're betting heavily that this massive upfront investment in the physical experience will drive a 2% growth in net sales and deliver an earnings per share between $7.50 and $8.50. It's a bold, high-stakes turnaround plan that proves physical retail isn't dead. It just has to work much harder to justify the trip.
It's a paradigm shift. Just like Leica realizing a phone needs to feel like a mechanical luxury to stand out, Target realizes a store needs to feel like an experience to survive the convenience of digital shopping.
And that brings us to the end of our deep dive today. We have covered an incredible amount of ground. We started with a geopolitical strike in the Middle East, causing a massive traffic jam of 200 LNG and oil tankers in the Strait of Hormuz.
We saw how that frozen supply chain triggered a historic, leverage-fueled margin collapse in the South Korean stock market.
We looked at how the enterprise AI boom is literally stealing the memory chips out of the global smartphone supply chain, forcing companies like Leica to build $2,300 tactile camera phones just to differentiate themselves.
We saw traditional Wall Street models revaluing Tesla purely as an AI robotics company, and Target spending billions of dollars to entirely redesign its physical home decor aisles. All of this is happening at exactly the same time.
Which raises an important question, and it's the final thought we want to leave you with today.
We so often think of the economy as isolated buckets. We put geopolitics in one bucket over here, technology over there, and consumer retail in its own little corner. But look at the patterns we've unpacked today. A boardroom decision to prioritize AI server farms in Silicon Valley directly degrades the internal memory specs inside a budget smartphone sold in Asia.
An anchored LNG ship waiting out a conflict in the Middle East immediately cascades into a margin call that wipes out an everyday retail trader sitting at a desk in Seoul.
The buckets simply don't exist. It is all one highly pressurized, deeply interconnected system. So the question to ponder is this. What hidden threads are tying your everyday purchases and your personal investments to a shipping port, a server farm, or geopolitical decision on the exact opposite side of the globe right now?
That is something to truly mull over next time you look at your portfolio or walk down a store aisle. Thank you so much for joining us on this deep dive. We love unpacking these complex webs with you, and we warmly invite you to keep questioning the world around you. Until next time,